Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and the Senior Portfolio Manager at McNichol & Associates Asset Management. First and foremost, I am very pleased to welcome all of our new viewers, thanks to my appearance on BNN yesterday. I do have to warn you all, however, that you are entering a new world, which we call Structural Valuation Analysis, or SVA for short. It is the confluence, a merger of fundamental and technical analysis. This will require you to learn more of what it is that we actually do before you will be truly comfortable, although you'll be able to pick up a lot from our weekly FANG Friday videos. We do have an introductory video on our YouTube homepage detailing everything that you will see today, and I have put a link in the description below. Click on it and you will gain access to our free introductory video about SVA. You can also click the link at the top of your screen right now. Now, before we take a closer look at the FANGs, as always, I do like to say thanks to everyone who likes this video and all our subscribers. We've been doing this for so long, it feels like a little investment family. Okay, let us start off with a look at Amazon. Now, Amazon, as you know, had a big miss, certainly in terms of earnings. Poor guidance, some call it light, has knocked the shares down, but not out. There was a beat on the bottom line, which was nice, however. The revenue miss is likely to carry on into the fourth quarter. The big long-term issue is whether or not the company is becoming mature and whether huge sales gains are any longer available. I expect, of course, that the market will tell us that. However, if the HB2 price, which is 12 times book value, fails to hold, I'm not really worried in the shorter term, but I would definitely keep a weather eye on the shares. Turning to Netflix, a reminder, I looked at its long-term trend that had refused to break out. When it did, okay, we pounced, and the stock has moved from strength to strength since that time. See, I can get this nice technical trend here, the technical top. When it broke out, bang, right over the HB3, which is 16 times book value, away it went. Microsoft, well, sales and earnings modestly beat consensus. The stock is strong, meets all expectation, and is now close to being the world's largest stock by market cap. It beat on both top and bottom lines, increasing revenue by 22% and reporting earnings per share of $2.27 versus a consensus of $2.07. I've been saying for some while, steady as she goes, and that's the way I feel. Alphabet, well, this many-headed hydra of a company, enjoyed strong digital advertising, and its earnings per share was well ahead of consensus. The structural prices have moved down a bit with the new current balance sheet, and it looks to be breaking out on rising and improving earnings numbers. So here was the stock. Last week we were looking at it with the new balance sheet in, however, look what's happened. It looks very much as if the stock is maybe trying to break out now. For the new FANG Friday viewers, your timing this week, as far as Alphabet is concerned, may have been impeccable. As far as Apple is concerned, here was the picture of Apple last week, and I had been saying to you for some time that I was looking for a new balance sheet because, you know, this big upsweep here in terms of the book value per share I didn't think was real because I thought that sharebacks were going to knock that back. Well, this quarter marks the first time since April of 2016 that Apple had failed to beat earnings estimates, and it's the first time since May 2017 that Apple's revenues have missed estimates, albeit a modest miss on supply issues, and the stock has set back. I kept saying that I needed that new balance sheet to see what the real valuation condition was, and now we've got it. And here it is. So the shares, far from falling down to support, turned out to be actually banging its head against overhead price valuation resistance, which is currently stands at about $152 or 33 times book value. We need a breakout to take any action on this stock. Finally, Facebook. The results were modestly weaker than expected, although still on the strong side. But it's overshadowed, of course, by other issues. The company is moving towards what they call the metaverse, and is even planning to change its name. And quite frankly, that may be a good thing to do when your current name is mud. However, all of this is temporarily overshadowed by its massive $50 billion share buyback program, which, as you can see, has already lowered our downside target from 300, which it nearly hit last week, to the current 280. That's the new mid-super growth price, or 5.5 times book value. Last week we were almost there, but now, as you can see, I can breathe a little bit easier now, as the decision to repurchase stock, which you'll recall we had sold a few weeks ago, can be put off a little longer. We are happily on side now in that sale, and should be even more so in the future. Here is our new downside target, $280. In summary, I have been informally running what I have called my Phantom FANG portfolio, consisting of the FANG stocks that I was comfortable with. Amazon, Netflix, Microsoft, and Nvidia were its cornerstones. But I had also included Alphabet, which I had refused to sell when it first got to its bubble price. That's 7.4 times book value. And I was temporarily chagrined to see what looked like a breakout then fail on me, and the stock had set back. Well, right now, as we speak, I may still not be entirely comfortable, but increasingly, I expect that this stock is trying to break out to valuations not seen in more than 10 years. It has been higher, but not for a long time. I was crossing my fingers on Apple to see what happens when we got to the next balance sheet, and now that we have it, we can see that I am, again, hopefully temporarily, on the wrong side of the fence. So, as you'll recall, I sold Facebook a few weeks ago, and now I'm pleased to be nicely on side. I showed our viewers that following the last scandal in this company in 2018, the shares dropped a full 2 breakpoints before finding their feet. That may be a stretch this time around, but for now I will remain cheerfully on the sidelines. To Facebook, I think must add Nvidia as a sell at its HB5 price. That's 26 times book value. Although you might want to wait until the third quarter earnings come in. Given its very stretched valuation, however, my secret fear is that we get an earnings surprise that underwhelms the market. Personally, I would probably sell now and take the equally good chance that Nvidia will produce great numbers and make me look like a scaredy cat. Anyway, my key takeaways for this week are First of all, I observed last week that as far as the overall market is concerned, it seemed to have got tired of selling off, and it looked to be heading north again. Third quarter earnings results for the FANGs are almost all in, and so are the new balance sheets. And I have to say that my low super growth price target for the Standard & Poor's, that's, remember, 5250, seems reasonable and remains intact, quite possibly led by most of the FANGs. For our new viewers, we have several clients who use the service to supplement their analysis and just to get an inside edge on the market that you can't get anywhere else. We've already had a tremendous response, and so we are providing a special offer to the next 3 subscribers. Send us an email. I want to hear about your own personal investment journey, and then we will see whether our service is right for you. We do have limited spots, so send in your email right away before they are gone. We'd love to have you join our community. For now, this has been Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.